Hi, everyone. This is Stu Glickman from CFRA. I head up the energy equity research effort for CFRA, and this webinar is a companion piece to a thematic research report that I produced in March of this year called Oil and Gas E&P, Identifying the Best Stewards of Capital Among Natural Gas Names. Basically, what I'm going to do is walk you through 5 different natural gas E&Ps that we have in our stars coverage. I'm going to evaluate them from an operational efficiency standpoint. I'm then going to kind of shift gears and evaluate them again, but from a market expectations standpoint. And then I'm going to marry those two together in what we call our expectations framework to identify, positive implications or negative implications from this particular theme for those 5 names. Quick legal disclaimer. Okay, so natural gas focused E&Ps and stars coverage. This is the reason we have these 5 companies is because these are the 5 producers that we have in our stars coverage that get at least 50% of total production from natural gas in the last fiscal year, the year ended 2020. You can see we've got, and they're sorted by what's called year-end proved reserves from highest to lowest. So EQT Corporation is the highest with year-end estimated 2020 proved reserves of 3.3 billion barrels of oil equivalent. Antero Resources was second, Cabot Oil and Gas third, Southwestern Energy fourth, and fifth being CNX Resources. So a couple things about proved reserves. This is a standard year-end report that every oil and gas company is going to produce. It's an assessment really of how much resources in place each firm thinks it has under the ground that it feels reasonably confident that it can turn into production in coming years. And there's different flavors of reserves, but these are the fact that these are identified as proved reserves. You can think of that as being kind of the least uncertain form of reserves under the ground. The second column is how much they actually produced in 2020 on a barrel of oil equivalent basis. Because every producer has a combination of crude oil on the one hand, natural gas on the other hand, and a distant cousin called NGLs. Collectively, this is a simple benchmark that allows you to compare one firm against the other, even if they have different types of production. So again, EQT produced around 684,000 BOE per day in 2020. CNX Resources was the smallest, produced about 233,000 BOE per day. Why is this relevant? Well, this is a declining resource business. So every unit of production that you pull out of the ground today is a unit of production you have to replace down the road. So the third column, or the last column, is the estimated reserve life. That tells you in sort of a hypothetical, what if every company stopped trying to find new reserves and just sort of coasted on what they already had on the books? How many years could they go at flat production rates and until the cupboard was bare? And so what this shows you is that across the 5 firms, they range somewhere between 13 years and 19 years worth of production. This means that even though replacing reserves isn't an imminent need, it is something they have to think about for the longer term. And the management teams of each of these companies, that because they're planning for the longer term, they do have to think about this. Okay, so we are going to evaluate these companies, as I mentioned, from an operational efficiency standpoint, and the metric of choice that we're going to develop is what's called the recycle ratio. The recycle ratio is it's a simple division of hedged cash flow netback per barrel in the numerator and F&D spending per BOE on the denominator. And I'll walk you through each of those in turn. The hedged cash flow netback per barrel, which is what we're showing on this slide, which shows you that it ranges roughly from about $2 per BOE to roughly a little more than $3 per BOE. This is a reflection of how much cash each firm is getting from its upstream operations, meaning when it pulls that oil and gas out of the ground and then sells it to customers, per unit of production, how much are they getting? The only difference between what they pull out of the ground and sell it for and what this number reflects is the word hedged, which means that, you know, every year a firm has the ability, if it wants to hedge future production, because they could be concerned about prices kind of collapsing on them. And so they will, in many cases, they will either register gains on locked-in production, or they will register losses on locked-in production. And if they do a good job on hedging and register gains, we capture that here as well. Fairly narrow range, $2 to $3 per BOE for each of these 5 firms on average over the last 4 years. Now we're going to turn to the denominator in the recycle ratio. This is what's called F&D cost. F&D stands for finding and developing. Whenever a firm is trying to replace its reserves with future reserves, there's a couple of different ways it can go about that. It can grow its operations organically. It can take existing reserves and try to develop them further, and so then you get into kind of extensions or discoveries from beyond what they already have on the books. They can do new exploration efforts, which are generally a little more risky, but have the potential to you know, discover larger finds that they can later turn into reserves. And lastly, any of these firms, if they wanted to, could go out and acquire assets or acquire acreage from other companies. And so there is an M&A influence here. All of that gets rolled up into an F&D cost. And then we think about, okay, well, they spent X dollars to try to boost proved reserves. How much do they actually improve their proved reserves that they have under the ground in their estimation? And so this range for the 5 companies ranges from about $2.50 per BOE on the low end to about $4 per BOE on the high end. Now we put all this together. Again, you have the hedged cash flow netback on the numerator, so it's how much cash did you get out of the ground from your upstream activities versus how much cash did you spend to replace those reserves with future reserves. That's in the denominator. Your goal is to have a recycle ratio of at least 100%. And we average this for each firm across the last 4 years. And what we find is that there is some variation across the 5 firms, anywhere from 61% at the low end to about 116% at the high end. Now, just a quick word on EQT. I'm actually going to go back for a second. EQT is the leftmost column here, 65%, not the greatest ratio, ranks 4th out of 5. But what's interesting about EQT is that EQT had a changing of the guard in mid-2019 when a fellow by the name of Toby Rice waged a proxy fight to win the approval of the board of directors and take over the leadership of the company. And his argument, which was you know, persuasive with investors and shareholders, was that the old management team had simply been, you know, had a cost structure that was simply too bloated, too ineffective, and that because of that, the company needed new management to kind of lead the way. And what's interesting here is that if you look at the recycle ratio by year, the blue bars represent the recycle ratio from the old management team. Again, not great results, 62% in 1 year in 2017, 92% in 2018. 2019 is that multicolored year because Toby Rice took over, I believe it was July of 2019. That ratio fell to about 59%. 2020 is the first full year that Toby Rice has been at the helm. And in our estimation, the recycle ratio dropped to about 45% in the first full year that he has been at the helm. I would argue that while these early results are not promising because they seem to be pointing in the opposite direction, I still think it's too early to draw conclusions. Mr. Rice has only had really 1 full year where he's had total control over CapEx allocation decisions. And so I think this is the kind of thing where EQT, being the largest firm of the 5, it's a little harder to turn around a battleship than it is to turn around a dinghy. And so I think some patience is warranted here to see what he and his team can accomplish in 2021. this is something that I introduced, which I'm calling the Empire Folly Index. The notion that sometimes management teams like to build empires by acquiring their way into higher size. And so what this does is it's a calculation of the recycle ratio all in minus the recycle ratio if you only looked at organic operations, meaning no M&A at all. And in most cases, the Empire Folly Index is mildly negative. It's the largest negative for EQT. It's actually slightly positive for CNX, which suggests that the CNX management team is making fairly savvy acquisitions that are at least well priced and getting more than their getting a decent bang for the buck when they are doing acquisitions. Now let's shift gears and look at market expectations. And the way I'm going to assess market expectations is through a concept called free cash flow yield. It's a measure of how much free cash per share are you expected to get versus price per share, meaning what do you have to pay up per share to acquire that estimated free cash flow. And we're using 2022 consensus estimates as a proxy here for a steady state world on the basis that, you know, even though we're on the road to recovery in 2021 from the pandemic, it seems pretty clear at this point that oil demand, energy demand in general, is not getting all the way back to pre-pandemic levels. And so 2022 is probably a better measuring stick, if you will, for where things should be in a steady state. Now, the higher the free cash flow yield, that implies the more subdued or more muted the market expectations are. The lower the free cash flow yield, the more that investors have been willing to bid up to acquire those firms. So we see two firms here, EQT on the one hand, CNX on the other hand, both well above the 11% average across the board, EQT at 13%, CNX at 16%. Conversely, you see the other three firms, Antero, Cabot Oil and Gas Southwestern, all have free cash flow yields, again, using consensus 2022 results that suggest that these companies, you know, are already winning favor with investors, and to acquire them at existing prices, you kind of have to pay up. So now we're going to put all of this together in CFRA's expectations framework. So we're kind of comparing in a 2x2 matrix way operating efficiency on the one hand, shown in the columns, and market expectations, excuse me, on the other hand, which are shown in the rows. The columns show you either having a strong recycle ratio, meaning above 100%, or a weak recycle ratio, meaning below 100%. And then conversely, high market expectations if you have a free cash flow yield above 11%, or low market expectations, a free cash flow yield below 100%. Below 11%. And so what you've got is the one that jumps out to me in green here is CNX. It has low market expectations. Its free cash flow yield is very high at 16%. It has a strong recycle ratio. So to me, this is a case of kind of mispricing, where I don't think CNX is getting adequate due for what it's able to put together for investors. Conversely, you've got in red Antero and Southwestern. Both of those have fairly high market expectations with low free cash flow yields, and yet historically their recycle ratios have been fairly weak. So expectations framework, I just want to take a quick aside here. It's a useful tool, but it's not always the whole story. So in CNX cases, in CNX Resources case, we do think CNX is mispriced. It's got, as I said before, a strong free cash flow yield. It's got strong operational performance. That to me seems like a mispricing that investors ought to pay attention to. Now, conversely, you've got Antero Resources, which again, I highlighted in red on the previous slide, but I think one of the things that isn't captured in that slide is that Antero has very high exposure to what are called natural gas liquids, or NGLs, and pricing for NGLs, in my opinion, is going to be fairly strong in both 2021 and 2022, and very different than NGL pricing 2017 through 2020. And so I think it's probably a safer bet, in my opinion, that Antero should be able to throw off fairly strong results in 2021 and 2022 perhaps better than past results would indicate because of their exposure to NGLs. So putting this all together, going back to the thematic research that I published in March, investment implications, the left-hand column, which of these firms do we put in the positive implications box? CNX is one. I just think that the underlying company, its outlook is better than what the market evaluates it at. CNX, we have a 5 stars opinion. EQT Corp, notwithstanding that it shows up in the negative category, the market expectations are really subdued, and we think it's a value play, and we're willing to wait longer for an operational turnaround. Conversely, negative implications. Antero Resources, yes, it's a buy. The implications from this evaluation of operational performance suggests that the market expectations are high. It does have a poor recycle ratio performance in the past. We're sticking with it as a buy because of their NGL exposure. Cabot Oil and Gas is a 3 stars name. It's a premium name, but it's expensive. And then lastly, you've got Southwestern Energy, which has a decent deviation from market expectations with a very low free cash flow yield, and yet it has negative operating performance in terms of recycle ratio. We had previously had a buy on this name earlier this year, but as the name moved up and as that free cash flow yield went down, we just didn't feel like there was enough bang for the buck there, and so we downgraded to a hold. So that is the end of this companion piece to go with the thematic research that we published in March. If you're interested in more information on any of these 5 names that I was highlighting today, recommend you go to MarketScope Advisor and look up each of these names for individual stock reports with earnings, so on, as well as some description of the business summaries, strategies, and things of that nature. Thanks for listening.